Well, hello, everyone, and welcome back to Chief Outsider's CEO Growth Talks. I'm Pete Hayes, your host, and my pleasure to welcome Patrick Moran, President, Co-Founder of Royce Partners, right down the street in Houston. Welcome, Patrick.
Hey, thanks a lot, Pete. Good afternoon.
Yeah, we've been waiting for this moment. We've been waiting for the big, beautiful bill to be passed, HR 1, so we could have a little commentary. Patrick's business is all about tax management, works a whole bunch in the energy field. So we got lots of things to talk about. Patrick, any other introduction you want to give for your organization?
Yeah, appreciate it, Pete. So Royce Partners, we're a consultancy actually based in Columbus, Ohio, and as Pete mentioned, down the street from Austin here in the sunny Houston, Texas today. As far as what we do, so we work with businesses that would like to achieve some level of tax mitigation. And specifically, what that looks like is through credits and incentives that live in the federal tax code. So we'll work with typically small to medium-sized businesses, some lower middle market mixed in there as well. And as Pete mentioned, a lot of companies in the energy industries, as well as various STEM fields.
Yeah, and we do, full disclosure, we've had a chance to work with Patrick and his organization briefly. And how long ago were we working with you, Patrick?
Yeah, last summer we worked together for a few months. We were putting together a new go-to-market strategy. Ironically, what has just passed with HR 1 here and some of the provisions that were within the bill actually restored some pieces of legislation that really impacted our business. Being tax consultants, all of what we do is interpreting and understanding the tax code for our clients. There's a lot of pivoting and changing our focus as it pertains to those legislative happenings. Well, what had taken place was, and we'll get into this a bit more later, I don't want to jump the gun just yet, but essentially our business was in a position where we wanted to reframe and refocus some of our messaging to our clients, specifically those that were looking to obtain a research and development tax credit. So in order to do that, there was a lot of complexities that had to be overcame. We wanted to reevaluate who our buyer persona was, or our ideal client profile, put that messaging in such a way that it could be really reflected across the entire firm and resonate with some of the happenings in that legislative environment that I talked about. So Pete's firm, they were incredible. We were able to really iron out all those pieces and deliver it in a way that we thought made sense.
Well, that's great. Thank you so much. We'll kill the commercial and let's move on to the bill itself. When you look at this whole thing, and I know that the centerpiece of it perhaps is actually what relates to your business as well, but just tell us about what happened. Why is it so big, and why would some folks consider it beautiful? Because I know a lot of people, it really does impact them. Why don't you just give us your quick summary of the bill?
Yeah, absolutely. And the most ironically named bill or tax legislation of the decade, I would say, the One Big Beautiful Bill Act. But as some brief context, it really is a sweeping budget reconciliation bill that touched a lot of different topics, from national defense to student loans, and of course taxes, which is really the focus that I'll stay within the lanes of today. As far as kind of what brought us here and what that has to do with research is a brief history lesson. And I know tax is typically pretty lively and fun, so I thought I'd try to bring us back to center a bit with some history, since I know that can typically liven up the topic a bit. But if we go back to the 1950s, essentially what had taken place was businesses engaging in research. They wanted the ability to expense 100% or deduct their research expenditures in a given tax year or calendar year.
Did it start with businesses wanting to do that, or was the government? Which came first? Was the government trying to get people to invest, and as a result provide the incentive? Which
I appreciate the clarification, because in the post-war era, Dwight D. Eisenhower's presidency there in that time actually was the period in which we wanted to stay competitive during the Cold War. We wanted to invest in innovation within the confines of the United States. And as a result of that, this legislation was introduced to allow businesses to then actually deduct these research expenditures 100%. So that's an important piece to consider here. And I appreciate the point of clarification, because it's all about the spirit of the legislation, right? That's why I find tax to be very interesting in some ways, is that you really see where the United States government wants to shape society, what we want to incentivize, what we don't want to incentivize. And typically, as people say, if you follow the money, you can follow the scenarios in which businesses and their operations somehow benefits whatever the United States government may want to march in that direction. So with that being said, the 50s, they come and go. It's not till the 1980s in which the R&D tax credit is first introduced. Once it was introduced, it was really for a lot of the big boys, your IBMs, your Lockheed Martins, and was more restrictive. Small business.
Is that the age of Reaganomics? Is that?
That's right, exactly. So moving across that age there, and continuing to see the United States commitment to investment in our own economy, specifically the economy that is innovative, and solidifying ourselves as throughout the world power era in the late 20th century. The introduction of that credit was furtherance upon that spirit of the legislation, as I mentioned before. So the only thing is that it missed the mark a bit, right? As I mentioned, that a lot of the big boys are the ones really profiting from this, or getting to reap the benefits and incentives, while small to medium-sized businesses in the middle market were overlooked. In the early 2000s, kind of ushered in the era in which R&D credits were available to small and medium-sized businesses. Legislation was expanded, made it easier to get. And the most important thing to really focus on here is that R&D credits can be for work done in companies that is not innovative in the sense that it's first of its kind. It's innovative in the sense that it's new to your business and it's new to you, but it's not first to the entire world, right? And this was really the spirit of competition, right? If I know my competitor down the street is creating a new software stack, and I know that their customers may benefit from that, well, then, hey, I think it's time that we look into what our software capabilities may look like, and hire on some developers and start competing against them. Does that make sense?
It makes sense. And it's crazy that Chief Outsiders, for the first time in the last tax year and then this year, we've been making our own R&D investments, including software, but also in terms of some new service areas where we've invested. So it's interesting.
Absolutely. And I'm going to use software as an example really throughout the course of this webinar. I think, although, and ironically, it is one of the more difficult industries to understand from a research and development standpoint, within the terms of kind of how the legislation is written, all this case law and decades of, back and forth in the courts of what can be considered a qualifying research activity. Applying that to software, just because it is so new, and there's not a lot of other comparisons that can be made to other industries, can be tough. But I think it's really easy for those of you in the audience that probably have some type of understanding of what software companies are doing now, at least from a high level. So with that in mind, an important thing for us to talk about, and what really caused all of this excitement, is what happened in 2017. The Trump administration had actually introduced this tax bill, the Tax Cuts and Jobs Act. And what happened in the Tax Cuts and Jobs Act was a reduction of the corporate tax rate and various other favorable tax incentives. But the question becomes, if we are now taking less money into the United States Treasury, well, then where are we going to receive dollars and cents from in the form of tax? There has to be some kind of pay for. And one of those pay-fors that was introduced was removing that piece that we mentioned in the 1950s, the Section 174 Section 174 deduction. It became Section 174 amortization. And all of that tax jargon just means, instead of having 100% deductions against your income with expenses that you are taking for your business, you now have to spread it across a few years or amortize it. And that was mandated by the TCJA. So I'll go ahead and pause here. And so Pete and I can kind of get into this a little bit. Again, I know it's jargony, but I promise.
So that took us to 2017, and then we had another administration, and then this bill comes back to that and does what?
So the bill actually created a restore of that change. And why that's so important is because if you are a business owner and you are investing in this innovation and, let's say software again, you want to create a new or improve software for your business. Maybe you already have one, but you want to continue to invest in it and make it better, make it more streamlined, easier to use. Well, why would I want to do that if all of those expenses that I'm taking toward that innovation that we just mentioned is now spread across a few years? The impact to me from a bottom line standpoint as a business owner is now it's not incentivized as much because my taxable income is actually going to go up. So with that change that occurred, and it was effective of 2022, so over these last 3 years, business owners have really had the opposite of an incentive and is really anti-business in a lot of ways. And I would say against the direction that the United States government, for as we've established the better part of the last century, has shown the direction they want to go. So it was really a fascinating pivot from where we've kind of established all of this momentum toward innovation and solidifying the United States as a world power whose economy is going to be innovative and competitive with those other economies across the globe. So for the first time, it created this this lack of incentivization, and really incentivized the opposite, which is concerning for a multitude of reasons.
Okay, but then.
And now here we are.
Here we are back again, right?
Here we are back again. As of July 4th, in HR1, or the One Big Beautiful Bill, that officially has been changed. So over these last few years, if you were a business owner that was impacted by 174, or maybe, as they say, better lucky than good, you didn't realize that you were impacted. Well, that's a scenario in which you can go back and actually fix what had been amortized over those 5 years, or basically go back and take those deductions head on and be able to put them back into the fold in those respective tax years. So now you can be made whole, so to speak. And what's nice to see in this bill as well is a provision that looks out for small businesses, which are really the backbone of the economy. And this provision says that you can do all these things. You can restore any impacts that you may have had over those last few years. If you're over $30 million in revenue, gross receipts, whatever your top line is, well, you, as a go forward, you don't have to amortize these expenses anymore, but you can't go back in time. So it's kind of nice to see that the legislation has come full circle. We're incentivizing innovation again. We're specifically making provisions that look out for small businesses and those larger businesses that can probably take the hit on their tax bill. The incentive is there for them to invest in innovation, but the last few years, are going to stay the way they were.
Okay, so that's the headline. So CEOs that are maybe they're not thinking, if they're not if they're not used to thinking in terms of capital investments and capital depreciations and those types of investments and write-offs and credits. Is it your expectation that some people are going to miss this?
Yeah, and that's the thing that we joke about. The IRS, they're a tax collection agency. They're not a marketing agency. They're not chief outsiders, right? They're the ones that are knocking on the door, the tax man, as they say. So with that in mind, it's actually incredible the number of businesses and our clients that had never heard of the R&D tax credit until we spoke with them, or their CPA, said, hey, I know a specialty tax firm that, we work alongside with. I'd encourage you guys to meet with them. And at least, we're always happy to, impart some education and awareness to these things, just given it's our mission, right? We want to serve and strengthen the U.S. economy from the ground up. So with that comes spreading a lot of education and awareness, conversations like this, right? Because so many businesses they don't know about it. So I think it is incredibly common that many CEOs, business owners, or potentially budding entrepreneurs that are thinking about their first new venture, this is just not something that comes to mind.
Wow. So they tell me what they miss. They're not thinking of the potential, but is it across these categories? Because in my mind, I get locked in on CapEx and
Mhm.
machinery and so forth. But to your point, you mentioned the software, but it doesn't even have to be a software
Mhm.
R&D. It could be what?
Yeah, great question. So yeah, what is an R&D tax credit? How does it work? And what's really interesting about it, it's really a wage-driven credit. And what that means is that the majority of the expenses that your company or the business, the taxpayer in this example, is investing into its staff, and specifically the technical staff, the amount of wages that they are paid actually goes toward the calculation of the R&D tax credit.
Mm,
And further, the contractors that they may pay,
mm.
those calculations, or the calculation is that those wages or contractor payments could be taken toward the R&D tax credit, right? Of course, there's all types of depends and buts and whatnot, but that's really the headline figure, is that thinking about R&D as something that is a newer, improved component of your business, a product like software, think like a platform that you've developed, or
Even
a
a service category, and
service category we see commonly. Really, the test is it a product, is it a process,
I
a
see.
formula, an invention, a
Uh,
software, or a technique.
uh,
And a product, let's think about like a manufacturing application, a widget, right, that may be made. Software obviously is going to be software, as we've mentioned. But to your point there, within a service category, a lot of our clients are that of engineering disciplines, right? So professional services and engineering firms that are providing engineering consulting services. The designs themselves, really could be considered, a product. So it's really expansive, and there is no industry requirement per se. Chief Outsiders is, as Pete mentioned, is a marketing company. But if they wanted to look into the opportunity for an R&D tax credit, well, it's because they're building a software. So the work itself is really what we're looking at, or the activity is how the IRS phrases it, is what would be considered qualified. And then those individuals and the expenses related to that activity is where the credit then comes from.
okay. All right. I want to change lanes a little bit and just kind of take advantage of your uh, wisdom and perspective on the bill.
Sure.
But maybe can we shift over to the energy side of things? I mean, there are a
Yeah, of
lot
course.
of changes made in tax credits and so forth. And
Mhm.
what happened? What's happened and for both businesses and consumers?
Yeah, it's pretty fascinating what has taken place over this last month. Multiple energy credits and incentives are getting gutted, for lack of a better word. They're winding out. It's not something that will exist and is no longer going to be a component of business planning for those businesses that are currently or have historically taken advantage of them. Namely, wind and solar, right? The investment in production tax credits have taken some of the biggest hits. Royce Partners and some of the services that we offer involve consulting around what's known as the energy efficient commercial building deduction, or 179D. And all that deduction states is, if you have a commercial building and it's been built and designed in an energy efficient way, you could potentially receive a tax deduction for it, right? Going back to what we said at the onset of our meeting today, spirit of the legislation. What do we want to see? We want to incentivize our society to invest in innovation with the R&D tax credit. We want to incentivize our society to hold important those projects that are of a green energy or renewable energy mantra and standard. So within that, there's been years and years of many tax credits and incentives. Some are new in President Biden through the IRA or the Inflation Reduction Act, introduced a plethora of these credits, or bolstered those that were already, on the books. So now, though, we're seeing this very unfortunate unwinding across the board for numerous energy credits and incentives. And to my point before, if you're a business that was previously taking advantage of these things, it really changes the way that you're looking forward and doing your forecasting and allocations of capex, et cetera.
Now, when you say it's unfortunate, is that is that a political statement? Is that because of the long-term investment that you still feel that the country should be making?
Yeah,
What's
I,
your
I
take
say
on
it's unfortunate from the standpoint of pro business, right? Royce
that?
Partners is pro business. All of the statements and um,
Mm,
services that we offer are that of supporting businesses and
okay.
uplifting the United States economy from the ground up. I'm actually a petroleum engineer by background and degree, and spent quite a few years in the oil and gas industry. Prior to coming on and co-founding Royce Partners. So as even a reformed oil man, I can certainly find the positive and the highly impactful
Yeah.
areas of the code that are going to support businesses. And competition is good, right? We want to remain energy independent. We want a strong energy infrastructure, whether that energy is derived, whole or in part by a variety of energy sources, right? That's important. So yeah, I find it unfortunate from a standpoint of investment from a business perspective, and ultimately, shaping society toward a direction of innovation and energy sustainability long term.
Okay. And now from a consumer standpoint, a couple things, EVs, solar panels. I mean,
Yeah,
everything's,
yeah. EVs, I believe, have a wind down of September
yeah,
of this year, right? And solar, I mean, very similar impacts.
end of the year. Yeah.
And all this means is adequate planning. And as I mentioned around the 174, implications. I mean, it's a pay for, right? Some of these things are pay for. Some of them are political sound bites, and we try to look across the last few decades of legislation to understand what is where's the direction of the economy going. Where is the policy and the spirit of the legislation behind these pieces and these packages and bills that are being introduced and passed. Where is all this trending? And with that in mind, one of the most important things you can do as any business owner is forecasting into the future. How can you look at where you are right now? How can you put your chips on the right color and make
Mm,
scientific assumptions about what
mm,
may take place? And that is all the more reason to do so right now. And maybe some of this is a pay for. Maybe it'll get fixed or restored, similar to how 174 has been restored. But until then, right, forecasting is incredibly important. Being savvy as a business owner, talking to your CFO, your CPA, a fractional CFO if you don't have a CFO, in order to adequately plan. Because if you're merely relying on which way the wind blows in Washington, I would encourage you to look across the last administration, who actually did not fix the impacts from the Tax Cuts and Jobs Act, right? So regardless of what side of the aisle you're on politically, it does not matter, right? Things will change very quickly, and your business will be affected as a result. So staying on top of that is incredibly important.
okay. So, kind of back to the sweet spot for Royce, and what, as a business owner and or an entrepreneur or both, what are the questions that I have that would cause me to reach out to you? What's going through my mind? Or
Mhm. Yeah, I would say number one, education is a cornerstone of what we do at Royce, right? Having the opportunity to talk to folks like you, Pete, and just put our messaging out there. As I mentioned, right, the IRS being a tax collection agency, they don't advertise these things.
Mm,
It's hard to parse through the jargon, and a lot of times IRS is a little behind the curve on when the bill may change to when guidance may be released, and the FAQs that a business owner who's a layperson in the terms of tax may understand. So if you have questions in general about what these impacts may mean, how you can do some of that savvy planning and sophistication I mentioned before, we're always happy to have a conversation as just a courtesy from one entrepreneur to another.
yeah, I think that's great that you are a consultancy, and that's where it starts, is having that conversation to just be educated, get some things figured out, explore some things. I don't know if anybody feels as though they've got all the answers with all the changes that have been made. And I
Right.
know so many companies haven't been thinking, oh yeah, this affects my world. And to your point that,
Mhm.
yeah, smaller businesses are really in a great position to take advantage of some of these things right now.
Yeah, absolutely. And that's something that, we really try to pride ourselves with, right? We know what we know what we don't know. And as they say in consulting, right? Billable hours and utilization, all these things. Well, those go toward actual client engagements, and we don't have client engagements where we're working on something we don't know. So if it's something that we truly don't know, we are more than happy to put whoever it may be in touch with a trusted professional, someone that we know, that we've vetted, we've talked with, and that ultimately they're going to have the same standards and values that we have at our firm. So yeah, knowing what you know and what you don't know is it important, very important in times like this where things are moving very quickly. It's a lot to stay on top of. So find someone that has that niche and knows it really, really darn well. And I think that'll serve you well as a business owner, to surround yourself with folks like
Well,
that.
that's great. And that's why we wanted to have you on the program in a timely fashion, since the act was passed just on the 4th of July.
That's right.
Patrick, what do you do for fun?
Oh man. Well, guitar is one. You got a couple ones on your
Yeah, I
over your
do.
left and right shoulder there. Love to play guitar. It's a great way to unwind. You know, after a
And
long
how does
day,
that relate to
some
the
tax
tax
code.
credit world? And is there any way to relate your guitar playing into? Is
Well,
there?
a manufacturer of guitars or amplifiers,
Yeah,
or software that would allow one to record their music. That's all sounds like a lot of qualified research to me.
that
We don't
that's
we don't
right.
have
You have,
we don't have any guitar manufacturers in our client base, but
but you could, and you maybe
good.
you will
And maybe we
starting
should.
tomorrow.
Yeah, I could be the subject matter expert there.
That's excellent.
That's right.
Well, Patrick, congratulations on growing Royce Partners to where it is today. You're on your way, and have a fantastic reputation in the industry. It's our pleasure to have worked with you a bit in the past year, and I'm just grateful for you being on the program today. Last words of wisdom. What should we
No,
be thinking?
I would think, what can you do right now for your business that
Mm,
will not just be in the next week, 3 weeks, 6 months, but what are you going to do for your business to help position it from, let's say, a marketing perspective, call chief outsiders, how you can adapt to these changes and stay on top of, how to really find that target buyer and convey that information from a tax perspective. Feel free to give us a call, right?
yeah.
It's a very difficult landscape to navigate right now, and I think the dust is starting to settle. So thinking, forward thinking, and having a lot of foresight in what's taking place right now, I think will really separate a lot of businesses from those who have planned and those who put it off to the last minute.
Excellent. Great advice. Well, thank you. Thank you, Patrick. And we'll see you everyone next time on CEO Growth Talks.
Yeah, thank you, Pete.